2025 was a wild ride. From deep personal lows to several amazing milestones I never even imagined were on my radar back in January. From starting a YouTube channel that rocketed out of the gates to watching my income portfolio keep delivering even with late season crypto chills and 180K in withdrawals to fund my retirement. It's been a year of learning, testing, and growing. Today, not only are we going to review how my PIIverse Income Portfolio performed through December, we're also looking back at my highs and lows during 2025 and how my 2025 lessons will shape my 2026. So, if you're interested, stick with me and let's go through it. Hello everybody, my name's Perry and welcome to the PIIverse. Today's agenda is going to be pretty busy because we're going to be tackling two topics at one time, as we said in the intro. We're not only going to tackle the month-end, December 2025 month-end income portfolio review, which I do every month, but we're also going to be tackling a year-end review of my portfolio and sort of some things that happen in my personal life as well. Anyways, so let's go through it. I'm going to start with a quick agenda. So what we're going to do is an introduction and a portfolio background for those viewers that don't know anything about my channel, my portfolio. They've just watched it. They're watching this for the first time. So give you guys a background. We're then going to do the December highlights. Followed by that, we're going to do a previous versus current month end metric, something I do every month. I follow a slated table that shows the changes from the previous months to the current month. We're then going to look under the hood of my PIIverse portfolio and get some details, some more detailed deep dive metrics using Snowball Analytics as my tool to show you some of the more gritty stuff that you want to know about how my portfolio performed inside for the past month. Then we're going to do an inserted slide, which is my PIIverse 2025 year in review special. It's just a one page to give you guys basically what I've noticed, my lows and my highs for 2025. And then we're going to finish it off with a looking forward for 2026 or the next month or two, as well as conclusions. So let's get started. Before we start, a very important notice to all viewers. I am not a licensed nor trained financial investment or tax expert. I am just a retail investor with a passion for investing, sharing my experiences along the way and along my journey. Do not take any content, thoughts, or opinions in this video as financial advice. Also, do your own research and consider professional advice before investing. This content is for fun and entertainment only, so hopefully you are educated or at least entertained. All right, so let's quickly go through the intro and a portfolio background to get people up to speed that don't know about my PIIverse portfolio and have a better background of what it is before we talk about what we're talking about current date. All right, like I said, I do at the end of every month, the beginning of the next month, I basically do a snapshot end of month review to get people up to speed on how things have changed in my portfolio from the previous month to the current month. So just sort of an up-to-date, where is my PIIverse portfolio going? Because I do know I have several subscribers, over almost 11,000 now. So thank you for all of you that are subscribed to me. If you aren't subscribed to me, I'm hoping you're going to find this video a tease that you would actually join my channel and subscribe to it as well. My focus on my channel is all about passive income investing strategies. I don't focus as much on each of the little ETFs that you put inside your portfolio. My whole channel, YouTube channel, is focused on strategy development. How do you build a strategy for building income portfolios that are sustainable? So if that's of interest to you, please press the subscribe button right now. All right, so this will be a 2025 PIIverse portfolio December and year-end review. And so let's get into a background of my PIIverse income portfolio for all those that don't know about my portfolio. Again, my name is Perry. I retired over 2 years ago now. It was October of 2023. And this income portfolio funds my entire retirement. The portfolio was built through all of 2023, and when I transitioned all my bank managed investments accounts and my mutual funds, I even cashed out my pension when I retired. So basically, I went all in on this one. My portfolio switched from bank managed using mutual funds and switched over to moving all my portfolio accounts. I have 7 of them, including my RIFs and my TFSAs and my non-registered. By the way, I'm Canadian, so for those American viewers, you're going to hear a lot of potential Canadian terms like Canadian registered accounts and sheltered accounts. Apologies for that, but that's basically who I am because that's where I live. All right. So in November of 2023, this portfolio completed its build phase. And with that, all my initial metrics always use that as my starting point. Even though I started building my portfolio in January, February 2023, I considered the transition to be completed at the end of November. So I always generally look as December 1 of 2023 is basically when my portfolio was officially mature and metrics were sort of tracked from that. Excuse me. So as of end of November 2023, my initial NAV was $1.28 million. That was my book NAV. As well as my book NAV and my current NAV are about the same at that time. So that's sort of like where they both met and moved forward from there. First month of distributions back in December 2023 was $19,000. Approximate yield at that time was 18%, which has changed dramatically since then. This is a self-funded. There are no external sources of income feeding my portfolio. Since I am retired, I have no other sources of income to feed generally money into it. So my portfolio generally is self-funded. Anything that makes it grow is from its reinvestment of its own generated income. So that's an important number to know. There might be maybe sometime if, say, an inheritance or something happens, but to date, there really has not been any contributions from external sources coming into my portfolio. It is self-funded and self-sufficient. My portfolio is in full consumption phase, with an annual draw rate or withdrawal rate of 13%. So for those that don't know what that term means, there are 2 major phases of investing. There is the accumulation phase or the growth phase, and then there's the consumption phase. In your early adult life, until the point you either fire or retire, you are building your portfolio's wealth. You're increasing its value. You're contributing to your RSPs. You're contributing to your non-registered with employment income or whatever sources you are. When you retire, you basically switch over to a consumption phase of which now your portfolio is serving you. You aren't serving it. You're not contributing to it. You are now basically receiving money from it. So this is referred to as the consumption phase, and that has been the case since December 2023 when I retired. And again, I currently withdraw about 13% of all generated income, 13% of the current portfolio NAV is generally withdrawn every year to fund my retirement. So to put it in a more hard number, in 2024, withdrawals from my portfolio was $240,000. And in 2025, withdrawals from my portfolio ended up being just around $180,000. So this is money that's leaving my portfolio. It's basically, if it wasn't for the fact that my portfolio generates new income and reinvests, this would be melting down. This would be drawing down the value of my portfolio because it is taking money out of the portfolio. It's extracting it out of the portfolio. And yet my portfolio still continues to grow. So all income producing covered call ETFs in my portfolio are in sheltered accounts. I currently hold them in my RIFs, my LIF and my TFSAs. Apologies to any non-Canadians that don't know what they are, but all of those are sheltered, tax-sheltered accounts. The LIFs and RIFs are retirement ones, and the TFSA is the tax-free savings account, which all citizens in Canada are entitled to have as long as they're over the age of 18. So I have no income generating holdings inside my non-registered. What the model is, I am a hybrid investor, even though I am definitely much more centric towards income. 85% of my portfolio is made up of covered calls and other derivative ETFs. 15% of the remaining part of my portfolio is made up of pure growth, high torque stocks, which I hold all in my non-registered. All right. So that is a snapshot for anyone that doesn't know what my portfolio history is. That is what we're working with. So now let's go through the month-end review. All right, we start with the December highlights. What were the highlights that happened through December? So let's go through them. The first thing is the crypto chill continued through December. If you watched my November one, basically for anybody that had investments in any form of crypto, Bitcoin, any of the crypto technologies, or even if you were in the technology sector, a lot of the technology sector was feeling it too. There's been a chill since late October, and it has continued all the way into December. For those people that don't know cover call ETFs that well, if you are working with high yield cover call ETFs, a lot of them do leverage crypto and tech because those have the highest volatility. So a lot of the cover call ETFs like investing in them. So if you are an income investor and you're looking at the higher yielding cover call ETFs, generally you would have been impacted by this crypto chill, this tech chill that continues as we speak. It's still not looking good out there. Let's hope that the crypto Bitcoin market does improve in 2026, but let's just assume that it's going to sort of have a rough ride for a while. But this is where we are. And for me, because I am a high yielding income investor, it did impact my portfolio's NAV and monthly distributions. All right, so let's talk about my December reinvestment and rebalancing moves. As an income portfolio investor, reinvestment and rebalancing are the two primary activities that are happening all the time. As a growth investor, first of all, reinvestment is not what happens that much because you don't have money income generated that you can reinvest. That can only be done through contributions. But as an income investor, reinvestment is a critical term and a critical activity that happens for income investors. The other one is rebalancing, which of course everybody rebalances if you're growth or income. It tends to be very popular for me because I have a lot of holdings and I'm always looking at rebalancing. So let's talk about those moves for December. The first big one was a rebalance. If anyone watched my previous months, they knew I was in a move to move down or reduce or close my Coney position from YieldMax. Officially, as of December, I closed out the remaining holdings I had in Coney. And so what I did is it was deemed a rebalance because the proceeds moved primarily into COIW and WPay. So that was the last major rebalancing for Coney. I currently now do not have any more Coney in my portfolio. I did my reinvestments for December is that I added to my ETFs TQQY. I did take advantage and added some more into MSTE. I know a lot of people are scared of it because it's down like 70%. I don't know what it is right now. Anything MSTR related is down, including Harvest's MSTE. And I thought to myself, you know what? I sort of believe sooner or later Bitcoin's going to improve. And if it does, I wanted to have a dollar cost averaging. So I did buy more into MSTE. I also, as part of my strategy moving towards 2026, and we'll talk about it later, I'm going to be doing a lot more reinvesting into, let's call it the low side of my boosters. Biggie is a low end booster, and I did invest into that. And I also invested in AVGW, which was the reason I did is because one of my accounts did not have a position in it yet. So I closed that. I basically filled that position so that all my accounts actually have AVGW. I also finished a major swing. I did a swing trade. For those that watch my channel and watch my activities, I'm a very big active user, active investor in Athabasca oil. I use it for swing trading for the past 3 years. I still had cash on hand waiting for Athabasca to drop in price. Well, it did that, and in December, I actually used up the remaining cash reserves for my swing buy or my swing sell, and I completed my swing buy. I added another 10,000 shares in 2 purchases, and I currently now am at my target size of 30,000 shares of Athabasca. I now have no cash. My cash position in my non-registered has all been used up, and they're basically been reinvested back into Athabasca. And now I'm just waiting for some future good days for oil, which right now with the geopolitical climate the way it is, it might take some time for Athabasca to be to move back up, because we need oil to come back up. Excuse me, I had to have a drink. The other one is I cut my monthly reinvesting pace and started building cash reserves. I'm just not saying much more about that one. So basically, I've decided that for Q1 of 2026, I'm going to be reducing my monthly RIF reinvesting so that I could build up a larger cash reserve inside my RIFs. The reason I'm doing it is because I do honestly believe, and it's just my own opinion, people might think otherwise, I think the way the geopolitical climate is and the economy, especially, the U.S. economy and stuff like that, which basically drives world economies, is not going to be good next year. I do believe that it's going to be a bear market in 2026. That's just my personal opinion. And if that's the case, I want to be ready for some good market downward swings like in the S&P and the Dow and the NASDAQ. So I do want to build up a cash reserve. And what I'm doing now is, instead of just reinvesting right away and dollar cost averaging reinvesting, I'm building up a cash reserve so that if the bear market does show up, I can actually have a bigger impact in buying my favorite cover call ETFs at much lower prices. So that is my thinking behind it. Again, if it's not a bear market, I still have the cash and I can still buy it later. The only exception to this holding on is this month, actually. Again, for those that are not Canadian, you don't understand this, but January is when our TFSA's headroom are increased. The federal government gives us an increase. I believe it's $7,000 headroom increase, of which we can reinvest because we're limited on how much each year we can add. Well, January is that month when we can do it. You can also basically recontribute back up what you withdrew in the previous years. And well, for 2025, I withdrew quite a lot of our TFSAs from both mine and my wife. So between that and both my wife and I getting a $7,000 headroom increase, I have about approximately almost $60,000 of headroom available. And I will be using RIF contributions, transferring my RIF cash balances over to start paying into my TFSA contributions. Of course, that means I get taxed by doing it, but whatever, there's no choice about it. In order for money to come out of my RIFs, I do have to pay taxes for it. But it moves into my TFSAs, which are all tax-free. So the future benefit is that my TFSAs that get this reward, this transferred money, will be able to be invested, and they will generate income that will be tax-free on all the years going forward. So it's a one-time hit so that my TFSAs can increase their ability to generate more compounding income tax-free. And then the last thing I want to point out, and this is a new section that I will be putting in every month from now on, it relates to my PIIverse pillar status. And for those that don't know what this is, back last month, I introduced a concept called the 3 covered call ETF pillars of income investing. I introduced it late November, early December. I actually did an update of it. I actually transformed my portfolio to absolutely integrate these pillars into my portfolio. So much so that I actually even have now integrated it into my snowball analytics, that these 3 pillars called anchors, boosters, and juicers, for those that don't know what it is, I'm going to say right now, look up at the top corner, you will see a link to this video. So if you don't know what I'm talking about, you're new to my channel, this is an important video for you to watch. It is a critical strategy component of my portfolio, income portfolio. I have now incorporated my pillars structure into my portfolio. And it's going to be so important for me now because I'm going to be tracking my portfolio based on its target weights for each one of these pillars: anchors, boosters, juicers. I also have growth stocks in there, which are not an income, but they are also another pillar, which are not ETFs. So because of that, I'm going to be showing this screen every month. I'll be showing the screen and showing the target versus its actual. And so that I could show the progress as I try to move my portfolio closer to what I've set as my target weight for each one of my pillars. Now, I want to go through this quickly here. So what you're looking at here, let's see if you can see my mouse. Yeah, you see my mouse. So this is my anchors. My anchors are my very conservative cover call ETFs. I did have it at a lower number, but then I decided, no, now I'm going to set to what I want to have as the actual target. So I've decided for the next 2 years, 2026, 2027, I'm going to be moving some of my juicers, my juicer weight over up into my anchors so that I'm going to become more conservative. It will lower my monthly income distributions or distribution income, but it will be making my portfolio more stable, more less volatile. So what I decided to do is I was at 27%, I think. It is now, it is currently allocated at 29%. I've increased my target for my anchors to eventually reach 33%. I don't know when I'm going to reach it, but I'm hoping I might reach it before mid 2026, but we'll see when that happens. Currently, my boosters, which is my middle tier risk versus reward type of pillar of ETFs, they are currently at 24.4%. I held it steady that I really would like to see it reach 26%. Then the one that I actually have lowered is my juicers. My juicers they currently are at 27%. I had it at 28%. I've now lowered it that I want to see my juicers reduced to being about 25% of my portfolio. So I've got about 3% reduction of my juicer ETF holdings to bring it down to the number that I'd like. The final one here is my growth stocks. This is my 3 stocks that I hold and I do have them as a pillar even though they're not income based, but since it is part of my portfolio, you could see that. And then also my snowball analytics tracks my cash position as well. So what you see here on this pie, this little pie here, is how each one of them makes up my portfolio. You see, if you could see very closely, you may not see it, there's a little dotted line. If the bar here, like anchors, is below that dotted line, it means it's underweight. It needs to increase. If, on the other hand, it is overweight, that means basically like juicers, it will basically be over the dotted bar and we actually need to bring it down. The reason cash is so far over that dotted line is because its target weight is only 1% and it's at 1.8%. So basically it's almost 2 times what its current weight should be. All right. This also gives me some great metrics in here because it tells me to date what my total profit is for each one of them. Obviously, my growth stocks have been my rock star, especially because of my Athabasca, my swing trading on this one. And I'm currently up 70%. Because it's a pure growth stock, it's all NAV appreciation. There is no income on this one. But I'm up 70% thanks to my Athabasca primarily. In this one for juicers, I am at a net profit of 16.41%. If I actually, and we'll look at these metrics when I open up my Snowball Analytics, but I'm currently running at a 16%. My boosters, believe it or not, are my lowest profit margins right now, running only at 9.6%. And then my anchors are, again, rock stars right behind growth stocks with their income generated and their NAV appreciation. My anchors are with an ROI of 66.3%. So this is going to be a chart I'm going to show every month so that I can show the progress as I move towards my targets. All right. And again, I hope you saw that video. If you didn't see the video, please take the time to watch that video. All right, now we're going to talk about previous versus current month-end results. These are just the facts. So here's the table of the metrics that I generally follow, and we did one major change, and I'll talk about it later at the very bottom. So basically, my book NAV at the end of November was 1.898 million, and I moved up to 1.905. This is all due generally to reinvesting. I added about $6,800 back into my portfolio's book NAV. Even though I had a lot of rebalancing, the rebalancing is that it's not really it doesn't really increase my book NAV. It's basically shuffling my book NAV. Therefore, the only increase that you see in book NAV is when you are actually reinvesting. You're taking the income that was generated and you're buying more cover call ETFs so that you can compound your income. So this is why I'm up 6,800, even though I've had a lot more, because again, I'm in a process of trying to accumulate cash reserves, and I'm trying to reduce the amount of reinvesting. Okay, the next one is my current NAV from last month. So at the end of November, my current NAV was 1.608. It's currently at 1.52. It's down $88,000. Or basically, book to current NAV is currently right now at minus 20%. So that would be this divided by this. It definitely went down. Again, this was the crypto chill really hitting home. It definitely affects my high yielding income portfolio because I do have a lot of juicers. And if you remember when you saw over on the previous page, juicers make up like 29% of my portfolio, and they are all heavily invested in Bitcoin and the Bitcoin technologies and all these crypto technologies as well as tech. And because those are hit hard, my current NAV has dropped a lot. Again, it dropped even in November, and then it dropped again in December, by the end of December. So this is definitely a low because of the crypto and tech chill. My cash positions last month, it ended at 6% cash position, which was generally very high for me. And that again was because of my Athabasca cash, my cash reserves in my non-reg that was waiting for Athabasca to drop in price so I could use those cash reserves. I did end up doing it, and I did some between that and reinvesting. I am now down to a number that I'm more comfortable with. I like about 1%, so I'm just a little bit higher because, again, I'm starting to build up my cash reserves because I've slowed down my reinvesting. So this number, I might be sending my target back up. It was at 1% because for next quarter, I want to see my reinvesting slow down. That's going to increase my cash reserves. So it won't be surprising if I slowly get up to 6% eventually again. So I could be ready for that bear market if it comes. Excuse me. The next one is my distributions and month-end yield. At the end of November, my month-end distributions was at 40,443, and it was at a yield of 33.13%. This month, my December distributions ended up at 43,215, 3,000 higher than November. And yet you're saying, well, but look, you're at a 30, you're actually lower in your yield. The reason that happened was, and I didn't actually list it here. First of all, there were a lot of 5-week payouts in December because I get paid on a lot of weeklies that happen Monday, Tuesday, Wednesday, Thursday, Friday. In November, there was a whole bunch of weekly pays that never made it to the end of November. They actually got pushed right to the first day of December. Those paid out in December. So there were several 5-week payouts that happened. But the other one that I didn't actually list in here, I should have actually listed in here, was the fact that Round Hill QDTE specifically, but even RDTE, but more so QDTE from Round Hill, paid out 2 whopping weekly distributions that was basically used to balance end of year assets that they appreciated on, and they have to pay it out. Regulatory requires them to do it. So they paid 2 weeks in a row. They paid the equivalent of a month, over a month and a half, 2 months worth of distributions twice. So it was almost like getting almost 3.5, 4 months of distributions from my QDTE, which normally is at around 20 cents, and I was getting like $1.90 something and then $1.70. Plus RDTE did a year end as well. So there was a massive increase in distributions for that. So that is why I ended up being 43,000. If it wasn't for that, I likely would have been down in the upper into the 39,000 range. My ROI and IRR for end of November were 34.3% for ROI and 21.76%. And they dropped because December was a continued crypto chill that really pulled down my portfolio. You could see that at the end of December, I've now dropped my ROI to 31.9% and my IRR to 20.05%. And again, this is the trend continuing on the crypto tech chill that's causing my yields to drop. My 12-month projected, at the end of November, my 12-month projected was 41.9K, which was at the time 12K below October's, which was actually one of the best months of the year I had. And that downward trend dropped slightly by the end of December. I'm now averaging projected by Snowball Analytics of 41K. So it's down by about 1.1K from the end of November. So again, related to the crypto tech chill, not only is my NAV dropping, but also my distributions are being pulled down. So my projections are just naturally pulled down with them. So it's now projecting 41K when it was 41.9. All right. My portfolio holdings, I always like showing how many portfolio holdings I have, as well as my top 3 rock stars. And it tends to be the same 3 or 4 that just jostle between them. End of November, I had 38 investments, basically 3 stocks and 35 ETFs. PLTE was the rock star at the time at 72% ROI, HDIV 66, and Call. Well, at the end of December, Call decided to move up to top rank. I now only have 37 holdings or investments, and that is because I sold out completely out of Coney. So now I have 33 stocks and 34 ETFs. My Call is now my top ROI at 71. Bank has now moved into second place, and it wasn't even in the top 3 to 70, and it's sharing its 70% ROI with PLTE. The last one here, which anybody that's watched my previous videos have always known, my last one was the Snowball Analytics volatility, the beta, and the Sortino ratio. There has been some major moves and changes because of my further investigation. There were some people saying they didn't believe those numbers because they were too high. And I have to admit that I was a little bit concerned myself. So I did have a very long dialogue back and forth with Snowball Analytics team. And there was definitely proven something that made me have to pull those metrics out. And basically, the way it works is Snowball Analytics does Sortino and beta volatility on all holdings that are older than 5 years old. Well, most of my covered call ETFs are under 5 years old. Therefore, what Snowball Analytics does is that their data providers give them no data, so they list them as blank. And so their calculations are massively skewed in the wrong direction. So I don't know exactly, because there's most of my covered call ETFs and my investments are less than 5 years old. There was no value in actually tracking Sortino ratio, Sharpe ratio, and the beta volatility, not until my covered call ETFs and all my investments generally are over 5 years. I did ask Snowball Analytics in my video review of their improvements that they need to point that out a lot more clearly, because since they do analyze it, they should actually be saying, hey, Perry, these metrics should not be trusted. They actually look at it when they calculate it. So they should actually look at it and also say, most of these are blank. So I'm going to give you a confidence number that's going to say, do not trust these metrics because the confidence number is too low, not enough data. I asked them to make that as an improvement to their site, because it's deceiving if you look at it and you think it's doing good. As a result, I took that metric out, and because I said that my pillars breakdown is so critical, I want to be tracking my pillar metrics a lot closer. So what you're seeing here is the first of, whoops, sorry, I got to go back here. All right, go back here. So what you see here is a snapshot out of my spreadsheet. I'm going to be doing this snapshot. Right now it's the first one. You can see previous month is NA because I don't have the metrics from the previous month. So what I'm going to do as of this one next month will be moved over to here, and then the new one will be updated here. This will help me and you see how my portfolio is progressing with regards to the performance of my anchors, my boosters, and my juicers. So right now, as of current month, as I said before, I have 37 total. So you see 37, 3 of them are stocks, 9 of them are anchors, 10 are boosters, and 15 are juicers. Their NAV makeup, and this is what's really cool in seeing these metrics, their NAV makeup right now, my stocks, because they have these 3, they make up 17% of my NAV, 29% of my NAV, 25% of my NAV, and 28% of my NAV. The income percentage is what's crazy. And this is because people keep asking me, Perry, if anchors are so stable and so good, even though they're lower and you don't have to reinvest as much, why would you not just buy more anchors and get rid of juicers? Well, here is the reason. Because even though my anchors make up 29% of my NAV, they only make up 11% of my total income each month. As compared to my juicers that also make up about the same amount, 29, and in this case, 28% of my NAV, but they generate 47% of all my income for the month. That's critical. So these are my 6-month average and my latest distributions for the month. So this is as of the end of December, and this is 6-month average of distributions over 6 months. So you could see basically, even though it's 29%, my anchors only contribute $5,500 on average, and my juicers contribute $31,000 on average. So that is why I hold juicers as part of my portfolio, is because, yeah, you're riding a Bronco and you get extreme highs and extreme lows, but it does generate a lot of income. And again, wild riding, because look at here. Currently, my 6-month average is $31,000. Right now, my juicers are only generating $23,000. That just shows you how wild swinging they are. As opposed to my anchors, which my average is $5,500, and currently its latest was actually up $100. So that shows you the difference between stability and income versus wild riding yield, and this is the difference. All right. This is an important metric. This is why it's so important for me, because I can now really structure my portfolio so that I can really say I need more anchors or I need more boosters. I don't have to say I need more of ETF 1, 2, 3. I can now say if I need boosters, then which one of the boosters is my next choice. But this really helps me maintain a very well-structured portfolio, because I can actually know which of the categories do I need to invest more in. And again, that was the previous page. All right. I hope you find this interesting. I think this is going to be way more valuable than having the volatility and the Sortino ratio. And again, I hope someday maybe Snowball can actually improve them so that we could use those metrics on smaller data than 5 years. It'd be nice if they could do it based on 2 years. But anyways, it is what it is. Okay, now we're going to look under the hood. This is where I actually jump back and forth between my presentation and my Snowball analytics. So we're going to look under the hood and see what the different metrics are that we are looking at. So again, if anybody doesn't know what Snowball Analytics is, and after looking at this, they're interested and they want to try it out, please use my link, because if you use my link, you get 10% off. Apologies during the holiday season, and I actually even brought it up with the Snowball Analytics team that actually just finished a 30% holiday season discount promotion. I'm sure they told me that you would get the 10% plus the 30%. And apparently I've been told by some of my viewers that they said when they approached Snowball, Snowball said you don't get both the 10 and the 30, you only get the 30. So I brought that up because I'm sure that was not what I was told. But anyways, it is what it is. That holiday discount is gone. So if you are interested in Snowball after seeing this, and you want 10% off, use my link that's in the pinned in the comments and you'll get 10% off. All right, so we're going to first talk about diversification. So in the diversification, generally I'm going to show you some of the highlights in here that basically it shows now that my portfolio is structured by pillars. So I'm going to show you how that works. After December, I also wanted to show in here that after December ended, the portfolio lowered diversification by 1 to 37. I'm going to also show how I sold my remaining Coney position, which then moved my Koi, WPay, and MST up. That was from that. And that my ATH, which is Athabasca Oil, increased as top spot because of me adding 10,000. So let me switch over to that so you can see what that is. All right, you are looking at my actual live PIIverse income portfolio. I just wanted to show right now, before I switch over to the first category, which is diversification, this is my main dashboard. You can see my current name as of today. So again, today is the 4th. So this is 4 days after December 31st. So the numbers may not line up with the end of month. But anyways, I'm currently at a portfolio of 1.524. My distribution or my book value is still 1.905. My ROI is currently at 32.1. This changes on an hourly basis because when the markets are open, this is always changing. It shows you here, if I'm just going to highlight it, that my capital gain, which is basically my losses over my invested, is down 380,000. But I have a realized profit and loss of 25,000. That's a profit I have. And my dividends received is almost $1 million. So this is since inception. So I've made almost $1 million in distributions since inception. And thereby, that's why my portfolio ROI is 32%. Even though my current NAV is 20% below my book NAV. IR is at 20.11, and my projected income is currently at 30.78. Or projected based on current distributions over the next 12 months is anticipated at $460,000. That changes depending on if the markets go up. If all of a sudden crypto starts skyrocketing again, this 460 will likely start going up big time, up to 550, 570, getting close to 600. So that's right now. We're on a chill market, let's just say. I showed you here. This is what you actually saw in the presentation a couple slides ago. I got it right from here. This does show you all the makeup. So you can see here, for example, here's cash position. So it shows you, here's my growth stocks, which basically shows that I have a capital gain of 14,000 plus. I've got 155 in actual realized capital gains over from my swing trading. This one shows you my juicers, showing how capital gains is down $279,000. My profit and loss is also down $92,000. That comes from selling juicers at a loss. So that is the realized losses. But I'm still up because my dividends received is 488,000 from my juicers. So I'm still up 16% because my distributions exceed all my capital gains and realized profit losses. My boosters are the surprising disappointments. It's supposed to be that my juicers should have had the lowest ROI, but it's actually my boosters that have the lowest ROI because they are being impacted by the crypto chill and they don't generate as much income as my juicers. Therefore, they are the low man on the totem pole because at an ROI of 9.62 because they have this similar kind of losses because of the crypto and they haven't generated as much income. That's why they're at 9.62. That's how the anomaly there. And then the big rock stars here are the anchors. They are at 66.34% gains. That's because I have a capital gain of 26,000. I have realized capital gains of 25,000. That's from what I call trimming my gains. And then I've also generated $220,000 over since inception. So it's gain, gain, and gain. And therefore, this is why my anchors have the best ROI. Anyways, that's all I'm going to talk about that. So I'm going to get back to the diversification. And that is this guy right here under analytics. I'm going to look at diversification. So this, just so people see, this is my diversification. Because people ask how diversified, Perry, is your portfolio? Again, I have 37 of them plus cash. That makes it 38. If you look at these, sorry, I'm having a drink of water. If you look at this, I'm not going to spend too much time on here. You could screen save this or screen share it and freeze the video. These are my portfolio makes up because my portfolio has a rule that generally says that no investment should have more than 5% in my portfolio. I do bend the rules on some occasions, and in this occasion, I have 3 ETFs that break the rule: HHIS, Bank, and ENCL. I also have my Athabasca that vastly breaks the rule at 14%. I will be making some alignments because of my move to more anchor positions. I'm going to be actually amending my rules, and I'm going to allow some of my anchors to have positions great as 10%. As such, I likely will be moving over the next year to my ENCL, Bank, HHIS, and a few others, even Biggie, and some of the others up to higher numbers. So because they're going to make up a bigger portion of my portfolio, I definitely want to increase their target weight. Right now, I think the target weight for ENCL is 8. So I'd like to move it up to 9 because as I add move stuff, I'm going to be adding to these positions. They're only going to get bigger because they are my stable ones. So anyways, that's what it shows you here. I just wanted to show you that. You guys can look at this all you want. This shows you, this one I don't even look at. So I'm not even going to look at this one. So this is the only one they have here. Again, at buy-in, it means this is what it was at cost. So if you wanted to see what my target weights were at cost, this is at cost. So this would be yield on cost or positions at cost. So this would be me at the time I bought them. This is at their current. So just want to show this is current. This is at cost. Okay. All right. We're going to go back now. We're going to move to the next one. So now we're going to move on to distributions in Snowball Analytics. We're going to move into that one. This is where I want to show again how the juicers continue to produce almost 50% of monthly versus my anchors. I'm going to also show the decline in December. And again, impacted by the chill. And not surprisingly, anchors have a plus yield on cost and juicers have a big minus on cost. And we'll talk about that right now. So let me get it back to there. All right, so that means I go into here, which is dividends. So these are a cool one. So this one here is showing that my yield currently, again, 30.78. My dividends at 460, as we already mentioned, with an average right now at 38,383. That's what it thinks right now is my monthly project, or I think that's my current month. No, that is my current. I think this is something I'm going to be asking them to fix. They don't really tell you if it's projected or not, and I believe this one is based on actual. So we'll see. All right. So what we're going to show, here's the important thing. So these are all my holdings. You'll see Coney is not in my list of them. This is everything actually paid out. So, all right. So when I do this, when you see this little bar here, that's telling you what the yield on cost is. You always would like to see your yield on cost to be equal to or higher than your actual dividend yield, because that means you bought it, it's generating yield, and it appreciated in value. So your yield on cost is actually greater than the actual yield. In the case where the bar is below it, it means basically that your yield is 190, but at the price you paid for it, your yield is only 130. You don't want to see bars down below the top of this bar. MSTY, obviously, anything that's from MSTR is not looking good. This one's really near the bottom. You can see there's a bad example of it. Anyways, so, and if you see it above it, like PLTE right here, you see PLTE is above it. It's one of the few, and Bank is above it. A lot of the anchors are above their bars because they're actually having better yield on cost than yield. What's really cool is I could switch to categories. Now, when I look at categories, you could see that when it comes to, remember I said the number, this is bad if it's below the bar. Juicers are so volatile, and they usually have a lot of either extreme NAV lag, or in many cases, they also have NAV erosion. As such, they generally, you will see that even though the dividend for juicers, the dividend yield should be at 51% based on current value, right now for mine, because they've eroded, a lot of my covered call ETFs in the juicer category have eroded, my yield on cost is currently only 31%. Boosters, you can see as you move towards anchors, it gets better. Boosters basically are closer to that bar, 46 versus 33. And then the anchors are actually even better. My yield on cost on anchors is better than my yield because a lot of my anchor cover call ETFs have actually appreciated in value since I bought them. And therefore, I'm actually getting better than the actual yield. But if you switch this over to actual payouts, you see a different story. So when you look at anchors, you're seeing how much was invested versus how much is actually paid out. So my invested is 415,000. So the blue bar is how much you invested in the anchors. The light blue bar here, the bar is actually how much you actually made in actual payouts. So this shows you the efficiency of your investment. Here, I invested 400,000 and I'm only making 67. I've only made 67,000 from that $400,000 investment. Slide on over to juicers and you see a totally different story. I've invested $700,000 in juicers, but they're generating $219,000 in actual payouts. So you're looking at anchors that only paid out 67, and you're looking at juicers that are paying out like, what is that? 3-4 times more, 219,000. Boosters are in the middle. They basically invested 500,000, and basically of that 500,000, it's made 174. These are actual payouts. So this is why when people ask me, well, why do you buy juicers? Why not just buy the anchors? Because look at how great the ROI is. Well, the ROI might be great, but since my focus on my portfolio is about income generation, and that's my focus more, again, call me a yield chaser, whatever name you want to call it. I'm not a growth chaser. I'm a yield chaser. So my focus is income focus. Therefore, I need to have some of these in here so that I can have more income being generated on a monthly basis. Now, that being said, I have already stated a few times in this video that in my next 2 years, I will be reducing my investment in juicers and moving them to anchors. Obviously, you can see what happens when I do. I will be realizing a lower and lower monthly distribution, but it is higher still than my LEPB ratio. That is my expense ratio. So therefore, because it's still much higher than how much I need from the retirement portfolio, I get a more volatile, I get a more stable portfolio by moving some of these and some of these maybe into anchors. So I have a better foundation or a better anchor position in my portfolio. All right. This one, I don't think I do anything more in here. This is showing my income based on, the juicers, the boosters, and the anchors. This is my projected. So you could see that juicers make up 47% of my projected. Boosters make up 37%, and anchors only make up 14% of my income. So this is the big difference. You get what you pay for. You either want stability and lower, and then pay the price by having lower income, or you go for the wild riding volatility and you get higher income. Again, you have to tolerate and have strategies dealing with juicers, which is including higher reinvestment to cover NAV erosion and stuff like that, which is something you really don't have to do with anchors. You don't have to put in mandatory reinvestment because they generally don't need reinvestment. They just have a small NAV lag, and that's it. I don't think there's anything more in here. This just, this shows you. The one thing I do want to show in here is my dividends received. So even though they go up and down, and that's again because of my juicers, you could see over the past year, it's gone down from 34 to up to 58, but I'm generally staying within an average. So this is good. Like what I wouldn't want to see is this thing continue to erode downward. It's not. It is. I get some lows and I get some highs. Right now, I'll likely be low. I'll be back into the 30s this month, I anticipate. But this is what's so important about doing this. All right. And then I could do it here. Dividends received showing again. This is my dividends received, my juicers versus my boosters versus my anchors. All right. But again, the point would be is my dividend growth. Now I've moved into 2026, so I lost my 2023. I'm sad. But now you can see that in 2024, it was slightly increasing. And in 2025, it was slightly increasing. So that's because of reinvestment causing compounding income. So it's slowly going up, even though the juicers are pulling it down again because they're highly volatile and they're doing NAV erosion at times. But because of the reinvestment, I can hold it stable and I can actually keep increasing my monthly distributions in a long-term trend. Okay, that's all I got for that one. So let's get back. I'm now going to talk about growth, which is the one that people really like to talk about if you are one of the people that are like, I'm a growth investor. And Perry, yeah, thank you very much for all the yields and the income generation. I want to see how your portfolio holds out against the S&P. How does it perform with regards to actual realized NAV and basically the profit and loss gains on that. So let's go talk about that one. Again, the crypto chill typically is going to be what the problem is. We're going to see some drops, but let's go and actually look at that. Okay, in order to do that, I go to this thing called growth. And we're going to do some cool things because now I actually can see my portfolio, not only at the portfolio level, but now that I've actually turned Snowball Analytics to track my pillars, this is what's really cool. So I've got this basically set to all. So this is when I started, was early January or February of 2023. You can see right about here is where my portfolio finished doing all its transition of all my mutual funds and accounts, and my this was my pension being cashed out and put into here. So right here is where my portfolio really started. You could see, and I'm comparing it to the S&P. So you could see the dotted purple line is the investment value. So that's how much is invested. Again, what you see here is less cash. So all you see is the holdings, no cash, because I know I'm at 1905. It says I'm at 1877, and that's because the cash position is removed from this chart because cash is cash. It's not an investment. So anyways, that's what the investment, the book value is. The orange line is the S&P, and the blue line is my portfolio. Of course, this is reinvesting and dividends included in here. So when you look at my portfolio, when you look at its growth and losses plus its distributions that it's gained, this is what I want to see. I don't mind that, like currently with the crypto chill, which is right about here, and let me move it in so I can see a 6-month period. It might be easier to see. So you could see the good news I see that makes me sleep at night is that, yeah, the S&P sometimes is up, Other times the S&P is down. You can see the blue tends to ride it. And it did actually good. It outdid my S&P throughout all the middle of 2025. And then the crypto chill started happening in late October right here. And that's where you can see that my portfolio is starting to lose against the S&P, because I am very heavily centric on crypto, which is extremely high volatile, which are actually hurting specifically, and the tech, which is also hurting. The S&P is a lot more broad-based, so therefore it's actually riding out these lows much better than mine. So you can see this is low. It does come back up and recovers quicker, but generally speaking, I'm not worried about this because I know it's because the markets are bad. The good news is that the S&P and my portfolio, these numbers are holding off to each other. They're generally in a race, but one is not just taking over and winning the race. The S&P and that are basically holding there. What you can also see here, remember I told you I've really put a pause on reinvesting, and you could see that is happening right here, because see this, every time I reinvest, this bar goes up. If I sell, for example, when I swing trade Athabasca, it goes down. But this is my reinvesting and rebalancing going on. Look what happened as of right about here, December 11th. Since December 11th, I have not done one reinvestment or rebalancing. So it's been flatlined for this. And that's because I'm holding right now and not doing any reinvestments or any rebalancing. And therefore, you're seeing this flat line. It's going to generally do this again. And we're going to, because until I reinvest or make trades, this is going to stay flat. Now, what's really cool, and this is what's new because of my 3 pillars of income, is I can now go by grouping. And this is what's really telling, because we talked about income, but now let's talk about actual, how do my ETFs in each category compete against each other with regards to the growth category. So right here, and I'm going to get rid of the growth stock because it doesn't belong here. So you can see here that the anchors, what you're going to see here, and I'm sure you guys can already visualize it. I'm going to move it to 1 year so that's a little bit bigger. This shows the difference in performance between an anchor, a booster, and a juicer. What you're going to see with, I'm going to get rid of my growth stock again. What you're going to see with anchors, which is this one right here, if you see it's down, it's because I'm actually, and again, I did do this. I sold some of my, my anchors back in early 2025 to buy more juicers and some boosters, because I was trimming some gains. So that's why you can see right here that the boosters are gone down. But if it's not being sold out because I'm reinvesting somewhere else, you can see the kind of flatlining here. You can also see with regards to my juicers that they have extreme highs and extreme lows. They are going all over the place. There's some reinvesting, but you can see how the valuation of them are actually flying up and down. And it's not just because of reinvesting and adding positions, but it's also because the value of these juicers are very volatile. You can see it reached back here on October 7th at one of its highs, and then the crypto chill happened, and you can see how it's gone down significantly. But at that same time, look at the anchors. If you look at the anchors at that same period where the juicers were down, they were flat as a board. It didn't even touch the anchors. And this is the benefit of having anchors in your portfolio, because if you want NAV stability, well, look at your anchors. The boosters are sitting in the middle here. They're sort of paying the price for me personally, because a lot of my boosters are crypto oriented. So they're a little bit on the down. They did take a little hit, but generally speaking, they were still a lot more stable than the juicers. And that is because juicers, if you watch the video, my juicers are considered single stock ETFs. They're extremely valuable, volatile. My boosters are made up of all-in-ones, indexes, and categories, sector-based. Therefore, they don't swing as much as boosters because they're being held by multiple positions in the underlying. So they are basically more stable, but their yield is lower because they are investing in crypto, which has actually reduced its distributions. So therefore, this guy's performing under my anchors, but you can see that. This is really cool, using Snowball to do categories. Now, this one is performance. This is really cool here. So if I go and look at the same ones now, this is categories. I'm going to get rid of my growth stock. But you can now see the big difference between, this is all based, forget about, there's no more investing versus de-investing and that. This is showing the volatility of each one of them over the past, since inception. If you look at, for example, my my anchors, the anchors, this is Liberation Day. When anyone wants to see, this is the Liberation Day event that happened in early April. So that's happened. All markets were impacted by that. But look at how the anchors basically recovered from it. It literally was like a straight line. It basically said, okay, fine, I'm just going to keep going up, going up, going up. Juicers are going, also, first of all, they take a bigger hit. They went down further, but they also came up really quickly. But whenever there's a problem, like, for example, the sector like crypto, look how fast they drop down, because they don't have any form of moderation, because they're only single stocks. And because a lot of mine are actually under the MSTR underlying, I have MISTY and MSTE, and I do also have LFGY. Several of them hold MSTR. Because they do, my juicers and my boosters actually didn't do too bad, but my juicers really dropped fast because of that. And this is the difference between boosters, juicers, and anchors. The anchors are very stable. They generally will grow. Portfolio performance is better on them. If you're looking for a total ROI improvement, something that gives you a little bit of income, but also gives you great NAV appreciation, that's why the anchors are really good if you want to balance between the two. If you're really focused on income, this is where the boosters and the juicers really help, especially the juicers, because they just pay too much. They pay a lot, but they are extremely volatile, very risky. You better be ready for them. Boosters are trying to be that moderation between the two, but they're sort of paying the price on being some of each. So there you go. I think this one's a fascinating one. I'm not going to really show this. This one here shows, as of end of December, what all my ETFs ROIs are. You can see call is the winner right now at 71%. This used to be, in October, I had almost no red. Because of the crypto chill and the tech chill, you could see a lot more of my cover call ETFs. Like, you can see about almost a third of them have now gone below zero. They have a negative ROI. MSTE is right now the biggest loser at minus 40, because it's newer and it hasn't increased. It hasn't provided enough income that basically can offset it. And it's been hit with huge capital losses, unrealized losses. So my unrealized losses are like 23% or minus 40, and my distributions can't keep up to it. So there you go. All right. So this is showing that this is because of the crypto chill. A lot of these are being affected by the crypto chill and the tech chill. LT is a techie. A lot of them are being hit by that. But on my winner side, which is more than half of them, HPYT now is actually in the positive. It used to be a negative. It is now slowly crawling its way up. This will slowly increase, people. If you understand how income portfolios work, every month you get a distribution, your ROI is going to go up, even though you got NAV that's going to actually pull it down again. But if you've got something that's relatively flat, let's say HPYT basically sits around the same price every month, it will continue to increase in ROI because the NAV appreciation has stayed stable, but it's increasing in appreciation in how much income it's generating. Every month it adds a little bit more, so that adds to the factor of ROI. And therefore, HPYT is slowly but surely crawling its way out of the red and just moved into the green for the first time in a long time. All right. That's about it for that. And I'm going to show quickly the Snowball report, but I'm not going to go through it in detail. I still think Snowball needs to do more work on it. Once they've really cleaned it up a little bit more, I'm going to actually incorporate it into my month end. I think there's some really good value with it, but they definitely need to improve it. They've added this section called report. Report really gives you a trend of everything. It's really powerful, but they do have a lot of little glitches they need. For example, the tutorial is not even related to this page. I've already reported all this to Snowball. They are going to hopefully do a lot of improvements, but this is really cool. This is basically a balance sheet, and I can see at a quarterly level, I can see it at a monthly level, I can see it for the past year or whatever, and I could basically click on any one of them and compare them, say, well, show me what my portfolio NAV is and my profit. So this shows you my NAV versus my profit. And this is really cool because this is showing me an important number. The bars show that I'm staying stable. Again, I'm in retirement. If I'm in retirement and my retirement portfolio is not eroding, think about a growth portfolio where you basically, it naturally will melt down. That's the only way it can generate you monthly retirement expenses is by selling assets. So slowly but surely, a growth portfolio will erode. So again, how fast is depending on how much income you're pulling out of it, meaning how many assets you sell. What's nice to see as an income portfolio during retirement is the fact that my NAV is not only not going down, it's actually increasing slowly. I actually wouldn't even care if it actually was stable or going down slowly, because at the end of the day, I know my portfolio is in retirement. The fact that it melts down or erodes is something a growth portfolio would have already accepted as going to happen. The fact that after 2 years, my portfolio is still actually staying stable or going up in value is why I really think high yield passive income investing is a game changer for passive income investors, because I can go for 20, 30 years and my portfolio is not eroding. It's actually going up because I'm following a strategy of significant reinvesting on the money that I don't need to spend for my retirement. Anyways, this is what's going to be really cool. Once they fix this and figure these out, these don't make sense to me. I'm not going to get you into the details, but I see this report going to be very valuable. You could click things like change. You could add any kind of these metrics saying, show me what percentages. Like, you could do a lot of cool things in here. Anyways, I'm not going to get into more. This is going to get better as they improve this, but it already is pretty valuable. Okay, that is it for Under the Hood. So let me go through the next section, which is my 2025. What happened to me in 2025? Let's look back. So it had a lot of highs, and unfortunately for me personally and my family, we had an extreme low. I will start by saying that I lost my mom on May 15th of 2025. I really do miss her bright life is always great spirit. It's something that I wish that would not have happened, but she was a great spirit right until her last days, and it's something I'm going to miss. So now let's talk about the highs. So on my highs, the first thing that was the biggest shocker for me at all was back in January. I had no anticipation of creating a YouTube video channel. It ended up happening in July 16th. When I was just going to do a YouTube video to show my spreadsheet, and it exploded from there. So I started my Perry's PIIverse YouTube channel on July 16th, and the success has been crazy and humbling. By the end of 2025, which was only 5.5 months later, I monetized my portfolio, my YouTube channel after only 6 weeks. And for 2025, I've already generated over $5,000. And it's just mind-boggling. I've already accumulated over 10,000, about 10,500 subscribers, and I've got 130 premium members of the the patrons and the Pillar members. I so appreciate those that actually are paying even extra money to have access to my patron service and my Pillar service. Thank you very much for even going that next step. But I do appreciate all subscribers for joining my channel. It's just been amazing that I have so many in only 5.5 months. I've produced 50 videos, 15 shorts, and I actually have one affiliate sponsor, which is Snowball Analytics. I just never would have imagined that this would ever have been. I've talked to a lot of people that started YouTube channels that said that I didn't even get monetized for 1.5 years. That it happened to me in 6 weeks. It blows my mind. The other metrics is that to date, I've basically is at 375,000 views, 75,000 hours of watching my videos. So I, again, thank you all members for watching my channel. And again, if you aren't subscribed, please subscribe. I really do try to provide value in helping income investors build strategies for successful, sustainable income. The second thing was that my PIIverse portfolio strategy kept delivering after 2 years of retirement. So even though I paid out $180,000 in expenses in 2025, and even with the crypto chill, I thought 2025, the fact that my portfolio generated $498,000 in distributions and my current NAV for 2025 only dropped $8,000. So again, this is what makes me feel good that for 2025, my portfolio was under stress with the crypto chill and the tech. And it's always under stress because I'm always consuming and withdrawing money from it every month. But even with it being withdrawn every month, $10,000 to $12,000 a month, and even though the crypto chill and other things like erosion are hitting it, the strategy is working by doing reinvesting and stuff like that. My portfolio is holding stable my NAV is holding stable. And so I'm very happy that 2025 showed very good progress with my portfolio being stable. And then finally, I have to do a shout out to all the things that happened to me in Blossom. For those that don't know, the Blossom social platform, it's a DIY investor platform for those that want to do investing for themselves. If you don't know about it, there's a link. Click the link on my pinned comment if you've never been in there, and please join me. I'm Perry F inside there. I can't believe that in 2025 I exceeded 10,000 followers. I got an award from Blossom for exceeding 5,000. Well, I'm over 10,000 now. I was able to attend my first Blossom Toronto tour event, which was huge. The Blossom team rented the Sky Dome. I call it the Sky Dome. They know I've called it Rogers Center, but I guess I still call it the Sky Dome. And it was so amazing to meet so many Blossomers that basically I only talk to online and on chat, basically on forums and stuff. But to actually meet them, sit down with them, meeting people like Paul, which is my fellow YouTube channel creator that started almost the same time I did. That was so cool. And then I worked with the local team here in Winnipeg, which was another big milestone for me. Winnipeg, me and the team that was here, local small team here in Winnipeg, we were able to set a new milestone for Blossom by actually creating the first Blossom local community event in Winnipeg. It was a huge success. We do have big plans to make an even better one in next year. And that was another major milestone for 2025. All right. So looking forward and conclusions before I end. First thing is, it was a big, so I'll be looking at beginning a RIF transferring my RIF generated income over to my TFSAs in January because I have a headroom of around 60,000. I don't think I'll be doing it all in January, but over the next 2 months, I would be transferring my RIF generated income and maximizing my headroom for my TFSAs. I do plan on having 2 major PIIverse strategy shifts in 2026. I hinted at both of them. The first thing is in anticipation for what I believe is a 2026 bear market. I've already mentioned to you that I plan on building up cash reserves over the next 3 months in anticipation that if there is a bear market, I will have a large cash reserve that I could buy into some of my favorite cover call ETFs at much lower prices. I'm actually hoping some of the anchors will drop, and that's like where I got some big wins on them 2 years ago. So that's why I'm doing that. The other thing is I'm planning a slow shift of my PIIverse to newly set pillar targets. I've already told you what they were in this video. I want to move more towards anchors and boosters and less towards juicers. And so that's going to be something that I'm going to be starting in 2026. It's going to be a slow progress, likely moving, not selling juicers and moving them, but more so reinvesting all my new generated monthly distributions towards anchors. And again, where there is a rebalancing opportunity, I will rebalance. The other thing is I plan on doing this. I don't know when, but I plan on opening my first Canadian cover call ETF position in my non-reg account. I might be using Athabasca capital gains if there's another good oil boom. If there's any capital gains from Athabasca, the sale of that, I'm going to experiment putting cover call ETFs in my non-registered, something I haven't done, and I want to do it and see what the tax implications are on it. So that's something I plan on doing in 2026. So in conclusion, I'm not worried about this crypto chill, or even if it went into a crypto winter, or if the global markets drop. And I've told you my strategy is to ride it out, but also start preparing that I can actually have cash reserves so that I can buy into these chills and into these market drops. So again, I'm not worried about it. You can see my portfolio is riding it out pretty good, even though my monthly distributions are dropping, because it's above my LEPB, which is my living expense protection buffer. I'm way above that number, so I'm not worried about it. There's a video on that. I'm going to click it here if you want to know about LEPB. I just put that video out last week. So look up right now. You'll see that. And if you want to know what LEPB buffers are. I hope you found this monthly review interesting. Please like, subscribe, and leave comments. Again, I know it's long-winded, but this was a double whammy of a December and a year in review. And so bear with me. And until next time, stay safe, stay investing, and I will see you in the PIIverse.